Hey everybody, it's John King with Summit Funding. It is Friday, the 24th of March. We have 7 days left this month before the end of the first quarter of 2023. Crazy how time has flown, and so much has changed in the last 3 months as we continue to have ever-changing economic and market conditions. And I've got a long update for you today. Please stick around to the end. I'm going to cover right now the topics I'm going to cover, then I'll dive into the topics, and then I'll kind of summarize things at the end. So stick around for the whole thing. So what am I going to talk about? The first thing I'm going to talk about is this week's Fed announcement. What did the Fed say on Wednesday, and what does that mean to the future of interest rates? The second thing I'm going to be talking about is what does this mess with banking mean to mortgage availability? We've got banks fail. We have more banks on the line. What is this going to mean to mortgages? The next thing I want to talk about is really, what about you? Do you need to worry about your bank failing? And what is this really going to mean to your personal financial life? The next topic I'm going to cover is changes to credit report criteria. Credit report modeling, I should say, for the mortgage industry is starting to take traction, and we expect that to happen in the near future. So I'll update you on what that means. I'm going to talk about a topic I've actually got a lot of questions about, which is how does a loan assumption really work? And can I make this work for my buyer or my seller if there's an assumable loan? The next topic I'm going to talk about is new appraisal rules. The appraisal guidelines are changing, huge changes to the appraisal rules coming out in April, and I'm going to explain that in detail. My last two topics, a 40% reduction in money available for the California Dream for All program. This one's big. For people who are thinking about California Dream for All, this one's critical. My last topic I'm going to talk about is regarding the California Dream for All program. We have received notice that my original expectations were not fully vetted, not fully, how should I say, accurate, and that there are higher credit score requirements than what I thought the first time I saw the guidelines. So I'm going to cover that. So let's dive in and let's start talking. This week on Wednesday, the Fed came out and they announced a 0.25% rate hike. Now, if you remember, for the last year, the Fed has been raising interest rates regularly with the fight against inflation. Well, inflation isn't over, but the Fed's level of how much they're attacking inflation and how much they're raising rates, the pace has slowed down. And there's a huge argument that that was probably the last rate hike for a while. Now, why? Because there's an adage that says the Fed raises rates until something breaks, and well, something broke. The banking industry broke. But it's kind of a blessing in disguise for the Fed, because the Fed now gets to say, hey, we don't have to be the big bad bully that's trying to slow down the economy. Instead, we've got the banking industry and the worries about the banking industry that's going to slow down the economy. The truth is, I think this is going to drive us into a recession. If you've been watching me for any amount of time, you've heard me talk. Recessions in and of themselves are not horrible. Recessions definitely harm those that lose their job. But a recession might take unemployment. The unemployment rate right now is, in the mid 3% range, which means 96.5% of the people that want to work have jobs. And at the peak of the worst recessions, we might get to 13% unemployment. That means 10% of the people that have jobs today won't. But 90% of the people that have jobs today will. So it's not going to be an issue that's going to impact everybody across every economic cycle or economic level. We're not going to see huge foreclosures. As a matter of fact, recessions lead to lower interest rates, which actually drive up house prices. The only recession in the past where house prices went down was the recession in 2008, and that was caused by bad mortgages. So it wasn't the recession that caused bad mortgages and caused housing prices to go down. It was bad mortgages that caused housing prices to go down and caused the recession. So what does this banking mess mean for mortgage availability? Let me be super clear. I am concerned about how this banking issue with all these big banks and small banks having problems is going to impact the mortgage world. Because we've got right now, Friday the 24th, and Deutsche Bank is now the next bank that is hearing some rumors of concerns. Credit Suisse folded last weekend. We had Silicon Valley Bank and Symmetry Bank, whatever the other bank is, that folded the week before. So we are seeing regular issues like we did in September of 2008, where you had banks collapsing over weekends. And I hate to say it, but we might wake up Monday morning and Deutsche Bank doesn't exist anymore. Now, how does that impact mortgage availability? Most jumbo loans are funded directly from large institutions pulling money out of their deposit base. And it's actually tying up that money so that they cannot give it back to their depositors if they want it back. Now, that's how the banking world goes around. Banks get your money, they turn around and loan it to somebody else, knowing that most people don't need their money for a long period of time. But that thinking is shifting right now because banks are getting called, like what we're seeing with Deutsche Bank, Credit Suisse last weekend. They're being called by regulators and by depositors and investors saying, hey, you don't have very much cash available. And if you needed to raise cash because the people that deposited money want it back, you're going to have things you invested in that you aren't ready to sell, that aren't worth selling right now, but you're going to have to sell them. And that's becoming an issue. I see already some banks pulling back their commitment to funding mortgages. I see more and more jumbo lenders tweaking their guidelines and saying, hey, I'm not going to fund as many loans this year as I originally thought because I need to keep that money liquid. So I'm super concerned about jumbo loans. I'm super concerned about what's called non-QM loans, or the fringe loans for lower credit score or for people who can't prove their income. Those types of loans are funded by banks taking their pot of money and throwing them into these investments that long-term pay back really well. But when you need to get to that money quickly, you're stuck. It's like putting your money into a 9-month CD and you need to pull it out 1 month later. It's going to cost you money to do that. You actually lose money if you don't keep the money in the CD as long as you had planned. Well, that's kind of the thinking with these mortgages, and I expect to continue to see more turmoil in the jumbo area, and I expect to see more turmoil when it comes to non-qualified mortgages or non-QM. Let's talk about what does this mean for you? What does all of this banking issue mean for your personal investments in your local bank? All of the money that you put into your bank, up to $250,000, is insured by the FDIC, the Federal Depository Insurance Corporation? I don't know. Anyway, FDIC. They insure that money that says, hey, if the bank fails, if the bank can't come up with enough cash to pay you out when you want it, we will cover that and we're going to make you whole. Really, within 1 business day, they're typically restoring people's money that they need for that they had on deposit. The problem really comes down to people who have over that $250,000. And mostly it's businesses. If you happen to be a consumer, an individual who's done really well and you have a bunch of money sitting in the bank, you might want to put it in 2 different banks because your FDIC coverage covers up to $250,000 per institution. I think it might even cover per account. But for sure, if you have a savings account at one bank and a savings account at another, each of them are covered up to the $250,000. I wouldn't go moving my money around and worrying about is my bank too big or too small. The fact is, live your life, keep doing what you're doing, and don't freak out about banking and whether this is going to impact you. Unless you have a significant amount of money in a single bank, it's not going to be an issue for you. There was a recent announcement from Fannie Mae and Freddie Mac talking about changes to the credit reporting model that they use. Now, we use an old FICO model that hasn't even been tweaked in almost 10 years. There's been a lot of newer versions of credit modeling. And I want to explain what credit modeling is. You might go onto Credit Karma, you might go onto your credit card app and you see one credit score, and then you call me and I say you have a totally different credit score. And blows your mind because you don't understand why the same information is different between all of these sources. And it's because of the algorithm, it's because of the formula that each of these credit models uses to say, hey, how are we predicting the future based on prior performance? A simple example of this is medical collections. Most of the new credit scoring formulas don't hurt you for having a medical collection because the credit system realized, hey, people don't go get sick on purpose and then skip paying off their medical bills on purpose. It's not an indicator of your risk. It's not an indicator that you're not going to pay your mortgage. It just means you got sick at a bad time, but you didn't plan ahead to get sick at that time. So the newer models have more rules that are built towards how people live their life today. Fannie Mae and Freddie Mac, the FHFA, has been talking recently about adopting new versions. And there's a couple of big game changers that I'm hearing. These are all preliminary rules that can change, but they're going to go from a tri-merge or 3 credit reports to a bi-merge or 2 credit reports. They're going to move to a more recent version of the credit score formula. So it's going to take into account other things that the old formulas didn't take into account. And it's supposed to be implemented sometime in 2025. Now that's 2 years away, but the fact is that's pretty quick because there's a lot of changes that have to happen. And this is going to make some significant changes, maybe in minimum credit scores, maybe in how we look at certain people in certain ways. So just be aware, this is going to be a game changer. We're a couple of years out, but I want to give you information as early as possible. Loan assumptions are when you have a seller who has an assumable loan and a buyer who wants to assume that loan. Now, why is this a big deal? Because interest rates are up here and the loan that's assumable probably has an interest rate down here. So if rates today are at 6%, then you're looking at interest rates that are going to be significantly lower than that. You're looking at interest rates that are maybe at 3% from a couple of years ago, and it'd be very attractive for a buyer to get a 3% interest rate. And so you say, hey, I got a buyer that wants to buy this $500,000 home, and he wants to assume the loan that the seller currently has. That's 2 major issues with this, which is how do you cover the difference between the current loan amount and the purchase price, and how long does it take to complete the process? So simple math. If the current owner owes $350,000 on their mortgage and the buyer wants to buy it for $500,000, you cannot increase the amount owed on that mortgage. So it's owed $350,000. Maybe it's a 3-year loan, 3 years into a 30-year loan. So the buyer is saying, I'm taking on the remaining 27 years. They're keeping the terms identical, including the fact that there's only 27 years left. The bank is simply transferring who's responsible from the current owner to the new person. But the bank's not loaning any extra money at that lower interest rate. So you either have to have the cash to cover the difference between the balance on the current mortgage and what the seller wants to get for the home, or you have to take out a loan for it. Hard to get second mortgages right now, especially if you have less than 20% down payment. So it means you got to cover at least the first 20%, and maybe you can get a second mortgage to cover the rest of it. But the final piece is this process is not handled by a loan originator like myself. It's handled by the customer service department at that bank. Now, what does that mean? It means that the customer service department is going to take the time that they have to get it done. The last one that I actually heard about started in January, and the customer service department that handled it said, yeah, we'll be done, we think, in May. That's a 4-month escrow from start to finish. So very, very important to understand what you're getting yourself into when you're doing this type of a loan. Is it's not handled by your local lender. It's handled by the customer service department of the bank that holds the loan right now. So it can be a very, very time-consuming process. And most of the time, they have to be owner-occupied. Effective April 15th, Fannie Mae and Freddie Mac are changing how they look at appraisals. Prior to now, they basically had 2 results that they gave, which is you either got an appraisal waiver that said, hey, you don't have to do an appraisal at all. And those were rare, but they would come by in certain circumstances, or you got the requirement for an appraisal. Well, Fannie Mae's changing the rules now, Freddie Mac as well, all conventional loans. And they're saying, look, we are now going to give you 3 results. We're going to give you value acceptance. That's kind of like the appraisal waiver. You didn't have to get an appraiser out there. Nobody drove by the home, nothing like that. We're going to give you value acceptance. And that is just like the appraisal waiver, but they've made it clear fewer homes are going to get a value acceptance than what used to get appraisal waivers. So the appraisal waiver percentage of transactions is going to drop and is being renamed value acceptance. Now there's a new category called value acceptance plus data collection. I think that's what they call it. I'm going to read my cheat sheet here. It says value acceptance plus property data. So when they say value acceptance plus property data, what they're doing is they're sending somebody out to the home to collect details about the property, to take pictures, to take measurements, basically do the stuff that the appraiser did, but check the condition of the property, but they're not coming up with a value. The computer has accepted the value, but they want a human to go out and check the condition of the property. Now, I don't know who's going to do that. I don't know. It does have to be somebody independent. It has to meet the appraisal independence requirements where I can't give undue influence to who that person is. So I don't know if this is appraisers that are just working for a lower price, if it's going to be realtors that do broker price opinions are now going to get hired to do these data, what do they call it? Property data reports. I don't know. But what I do know is they said there's going to be a larger segment of transactions that when I run it through the computer, it's going to say, yeah, we accept the value, but we want to get property data. We want somebody to go out there and validate the data. And as long as the data matches what we expected and the condition matches what we expected, you can proceed without a problem. So that's a really, really big change. I'm not sure what that's going to mean to the cost of the appraisal since it's only going to be property collection, data collection. I'm not sure what it's going to mean to turn times. We're going to learn. I also understand that the buyer will still have the option to do a full appraisal. Now, you can't, once you've done an appraisal, you can't go backwards and say, no, I want to go back to the value acceptance. You cannot undo an appraisal that's been done. But if you'd rather do an appraisal, my understanding is you absolutely have that right. Okay, so the next two topics I want to talk about are about the California Dream for All program and two really big changes that are impacting everything that I've been teaching people about over the last few weeks about California Dream for All. First of all, the California Dream for All program is a really, really good down payment assistance program. And if you don't know enough about it, check out my YouTube channel on it. There'll be a link down below to my YouTube channel. But I want to talk about the amount of money that's available to the California Dream for All program. When this program was announced, State of California said, I'm setting aside $500 million towards this program. And that's all of the information that I've seen and everything that I've read talked about that $500 million number. And the other night, I started doing a little bit of digging and I came across some articles and some information about budget issues at the state of California that happened just 2 months ago in January of 2023. And the governor 9 months ago was talking about how much of a budget surplus there was and how much extra money we had in the budget and that they were talking about projects they were going to fund. And now 2 months ago in January, we're short money. And they had to make cuts to certain projects that they had committed to. One of those projects they're cutting is the amount of money set aside for the California Dream for All program. They're cutting off 40% of the money. We are basically running out of money before the program's already started. Instead of having 500 million, we're only going to have 300 million. Now, my math says the average person is taking about $120,000. So the original calculation, I thought we'd have about 4,200 families that would be helped with this program. That's now dropping to 2,500. So when I thought this might last 6 to 9 months, we might be only 3 to 6 months before this money runs out. Now, it's supposed to be renewed, but we were also supposed to get $500 million from day one, and we're not getting the $500 million that was promised. So are we going to get the $1 billion every year going forward? At some point, I think we will get more money. How quickly we're going to get it, how long of a lapse there's going to be, and are they really going to fund the full $1 billion per year they talked about? Well, if we don't have a budget surplus, there's no money for them to give us. So we got to not only understand that it's what the state wants, but it's what the state can provide that is going to matter. The other thing that changed about my understanding is the credit score requirements. The California Dream for All program requires a 680 credit score for everybody on the loan unless you're below 80% of the area median income. If your total income for your family is less than 80% of the area median income, then you can get away with a 660 credit score as a bare minimum. But if you make more than 80% of the area median income, then you are subject to a 680 minimum credit score for everybody on the loan. That's different than what I had thought originally, and I want to make sure I get that information out here so that you understand there is absolutely a minimum of 680 for most people, unless you're below 80% of the area median income, and then we can go to a 660 if you're below 80% area median income, 680 if you're above 80% of the area median income. So, hey, here's the deal. In summary, the biggest thing I want to make clear is the Fed's most recent announcement is actually leading to lower interest rates. We saw the 10-year Treasury drop in the last couple of days, lower than it's been in the last 6 months. That's good news. It's kind of the 10-year treasury leads the charge for interest rates to go lower. So I think we're on the precipice of seeing lower interest rates. Mortgage rates are slowly following behind. But where the 10-year treasury is right now, we should be seeing interest rates and mortgages in the high fives. But mortgages trail behind. Kind of think about a ski boat towing a skier, okay? The ski boat turns and the skier stays behind, and if the ski boat goes the other way, the skier kind of stays in the middle, okay? Hopefully that analogy makes sense. So the boat is turning a lot faster, and the skier tows behind, and then when the boat turns back, the skier never swept out as far in most cases. Not sure if that analogy makes sense. Hopefully it does. The bottom line is mortgage rates come slower behind. But if the 10-year treasury shoots back up, then mortgage rates are saying, thank God we didn't go down at all, because that was a worry. If we went down too quickly, we could be losing money when we end up selling those mortgages once the house funds. That's the biggest issue with mortgages, is that we're not actually selling the loan to the investor for probably 60 days after we lock the interest rate. So the mortgage world lags behind as interest rates go down. They lead the charge when interest rates go up. They lag behind when interest rates go down. But this move with the Fed this week and their tone of how they explained things on Wednesday, Jerome Powell is making it clear to me they're ready to stop raising their interest rates. And that is all that the bond market needed to hear, along with this banking crisis, that we are on our way to lower interest rates. Where they're going to stop, I don't know. But I think our next stop is somewhere in the high fives. Right now, we're in the mid sixes, depending upon the loan program. In some cases, we can get you into the fives, but hang on tight because it's going to be a wild ride. Thank you so much for listening. If you made it all the way through it, this is probably one of my longest updates. Appreciate you all and have an absolutely wonderful weekend. Call me if you need anything. Bye-bye.